Joining us now to talk more about this, the Fed rates Judy Shelton, a senior fellow at the Independent Institute and a former Federal Reserve Board nominee. She's also the author of Money Meltdown, Restoring Order to the Global Currency System. Judy, it's great to have you on. Just let's start by, let's not think about past mistakes that the Fed has made. Let's think about this. At this point in time, do you think the risk is greater that the Fed relaxes its stance too easy or too early, or continues to stay too tight for too long? Which is the big risk to the markets right now?
Well, what a world, Joe, where we're having to interpret whether there was any kind of a half wink in those statements from a monetary policy official. I think it's a mistake for the Fed to make decisions in accordance with some kind of false bravado. I don't think what Chairman Powell is doing is similar to what Paul Volcker did. Paul Volcker really was targeting the money supply. He let interest rates go wherever they had to go. In October 1980, the FOMC directive said that the federal funds target would be between 8 and 14%. The point being, the Fed was selling off its securities to move the interest rate. This Fed is doing something very different. They are paying a record high interest rate on a record high pile of cash kept at the Fed, effectively bribing commercial banks and money market funds to keep that money from doing anything productive. Keep it in cash in a risk-free, government-guaranteed account, receiving over 3% now, maybe 4.5% by the end of the year. I mean, as little sense as it made to pay people not to work, now our central bank is paying banks not to lend and paying money market funds not to allow their cash to finance productive investment in the real economy.
If you wanted to hurt demand, that's one way to do it. Or if you wanted to cause demand to be less to bring down inflation, which is the tool that the Fed uses, that's a viable way of doing it. The question is whether you kill the patient in the process, and whether inflation at this point really is ingrained for a long period of time. Or maybe it is quasi-transitory because of this crazy labor market that resulted from the pandemic, from the reopening. What if it's not a wage price spiral like back in the 70s? If we go up another 3 or 4 total points, what if that's way too much, Judy?
Well, exactly. And the problem with the way the Fed sets interest rates by paying money on cash is that we really don't know what the real rate, what the real cost of capital should be. It's artificially established. And all we know is that the Fed thinks it should be restrictive. And think of that. Where is the logic? At a time when we're trying to increase supply to soak up the demand, the Fed's strategy is to slow down economic growth. And at a time when we're finally coaxing people to come back to work, the Fed's strategy is to increase unemployment. And I really think your point is well taken on the impact on the patient. I think we'll look back on this era of central banking the same way we look at medieval medicine, where the idea was that doctors would help get rid of a sickness by bleeding the patient. I don't think the Fed has made a compelling case for why crushing demand is the best way to address inflation.
Shepard Smith here. Thanks for watching CNBC on YouTube.